Welcome to the fourth and final installation of National Grand Bank's mortgage video series. Today we're going to talk about what product is best for you and when it is time to refinance. First is a fixed rate mortgage. A fixed rate mortgage doesn't require a lot of explanation. The rates are obviously fixed and they will never change the life of the loan. And your principal and interest payments are locked in and you know what the minimum payment will be for the life of the loan. Next is an adjustable rate mortgage, which it can be very complex and it's a very different animal. Some of the key terms in an adjustable rate mortgage you need to know and understand are: 1. The note rate. This is the rate you'll be paying of interest. This will be the rate that you lock in at application and your initial payment will be calculated from. Next is the term. This applies to how long your adjustable rate mortgage is fixed for. For example, a 5/1 ARM is fixed for the first 5 years, and then it adjusts annually in every year thereafter for the total term of the loan, which is 30 years. Then there's the index. The index is what triggers whether or not your rate will go up or down in the future. The most common index is the 1-year Treasury bill that's published in the Wall Street Journal every day, and you'll find this quoted in your adjustable rate mortgage disclosure that your lender will give you before application, as well as your mortgage note at closing. Then there's the margin. Margin is very important and very few borrowers ever ask what the margin is. Let's use an example. Let's say you have a 3.5% 5/1 ARM. The index is the 1-year T-bill and your caps on your loan are 2 and 6. In year 6, when the loan is ready to adjust, the lender will go to the index, the 1-year T-bill, and in this example, let's say it's 3%. They will add your margin, and in this example, it's 2.75%. They'll add those two figures together and your rate should be 5.75%. Adjustment caps. If you have caps of 2 and 6, it means that the rate can never go up or down more than 2% per adjustment and never more than 6% above the note rate for the life of the loan. So in year 6, if you have a 2% adjustment cap and your rate was 3.5%, it can never go above 5.5% on that first adjustment. Even though in our example it could go up to 5.75%, it won't because your caps are protecting you. Using this same example, if your margin was 3%, your rate should adjust to 6%. Only the caps will protect you and keep the rate at 5.5. All things being equal though, in the future, if your margin is 3%, your rate will always adjust at 1/4% higher, so the margin is very important. Once you've been pre-qualified for a mortgage, made an offer, and it's been accepted, the next thing you need to do is pick out a mortgage product. There are certain things that will influence your decision. If you're a young couple without any children, and you're buying a 1-bedroom condo and plan to have children someday, I may recommend that you get a 5-year adjustable rate mortgage, because you will probably outgrow this space, but that's a discussion that needs to happen with your mortgage professional, because why pay more interest for a fixed rate mortgage than an adjustable if you're never going to use it? If you're on a busy corner and you don't have children, that's fine. But if you decide you want to have children at some point, the location isn't ideal for kids, that may be another reason to go with an adjustable rate mortgage, because the time frame of the loan isn't going to be that long. Employment can also affect what type of mortgage you want to apply for. If you relocate for your job quite frequently, say you have a 3-year contract in your job, but you want to buy a house because you rather own than rent, again, that might be a situation where I would recommend an adjustable rate mortgage because you do not need the protection of a 30-year fixed rate. Rate cycle may also be very influential in looking at a mortgage product. For example, if rates are currently in the 6, 7, or 8% range, and in the prior years they were in the 3, 4, or 5% range, and may counsel a home buyer again about choosing an adjustable rate mortgage, because analysts think sometime in the next 3 to 6 years rates will drop and allow you to refinance into a lower fixed rate product. Conversely, if rates are really low, there is very little reason not to go with a fixed rate mortgage unless you're entirely sure you're going to be in and out of that property quickly. Property. If you're buying an investment property like a multifamily home that you're going to rent, I will probably talk to you about fixed rate versus an adjustable, and most likely will advise a fixed rate because you always know what you have to cover year in and year out to towards mortgage expenses. An ARM could really cut into your profit if rates rise in the future. However, this will obviously be determined by the current rate environment. And lastly is risk tolerance. If you're going to stay awake at night worrying about your mortgage adjusting in 2 to 3 years, you probably don't want an adjustable rate mortgage. If you don't like risk, a fixed rate is probably what you'll need. Next, we're going to talk about why you may want to refinance your mortgage. And there are many reasons that may influence this decision, and they're not all about rate. Cash out of the home. If your home has become too small and you need to add a room, or if you want to renovate an existing room, you can do a cash out refinance. If you owe $200,000 and you need to put an addition on the house for $100,000, and your house is currently worth $500,000, as long as you qualify, your lender will give you an extra $100,000 out of the home's equity. You refinance and walk away with the money and do the addition. That's one popular reason for refinancing. Another reason to refinance, and an obvious reason, is a lower rate. If you have a 5% rate on your home and going rates are at 3.5%, it would certainly make sense to refinance your home as long as you're going to stay in the home. Another reason people may want to refinance their mortgage is just to lower their payment, and it may have nothing to do with interest rate. Let's take an example of a couple that has children aged 17, 18, and 19. They may have 3 children in college at the same time. And they may be in a 15-year mortgage and their mortgage payment is too much to handle when they have 3 children in college. They may refinance into a 30-year fixed rate mortgage just to lower their monthly payment for those next 4 to 6 years when their children will be in college. And then they'll make a different decision after children are out of college. Some people will want to do just the opposite and to pay their mortgage off sooner. If someone is planning to retire at age 65 and they're 50 years old but still have 25 years left on their mortgage, they may want to refinance to a 15-year loan and be forced into paying their loan off in 15 years or less. Again, it's a lifestyle decision and it's not based solely on rate. Thank you very much for watching the National Grand Bank Mortgage video series. We're your local bank. We're part of your community. Please feel free to come down and talk with us at any time about your mortgage needs. If you need anything from us, you can also find us online at ngbank.com. Thank you very much again and have a great day.